Welcome to today's Trust and Estate webinar. This is an annual event the EACC organizes. We realize that many of our members have multinational families or are what we call business nomads and affected by this issue. This event is organized by the European American Chamber of Commerce, where Europeans and Americans connect to do business. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC in New York, and I will be your host for today's event. Our program today will address the financial planning and tax implications for multinational families, citizens, residents, and non-resident aliens, otherwise known as green card holders. Our panel will cover topics such as pre-immigration, tax planning, U.S. income tax issues for non-citizens or non-residents, expatriation planning, meaning when you're leaving the United States, what you need to know, income, gift, and tax plan, estate tax planning. We divided the program in 3 sections: tax, legal, and financial issues, and we have an expert for each one of those. And you will be able to take on hands-on advice to help you plan ahead. And the key sentence here is planning ahead. And I encourage you to reach out to the panelists after the event. I guarantee you, you will have more, once you digest the information that you hear today, you will have additional questions. Our speakers today include Paul Farrar. He's the Managing Director of Wealth Strategy Advisor at Bank of America's Private Bank. Paul offers his clients advice on complex estate and financial planning, as well as guidance on international trust and estate issues. Beth Trachtenberg is a partner at the private client practice of Steptoe and Johnson and one of our newest members. Firm joined this month. Beth guides high net worth individuals and families in international and domestic estate planning and administration. She also advises tax-exempt organizations. Timothy Lawson is the Director of Tax Services at Berkowitz, Pollack & Brunt, and Tim has more than 28 years of professional experience, including public accounting and private industry. Tim is our moderator for today's event, and I will hand over to him to take it from there. Tim?
Perfect. Thank you, Yvonne. And good morning. So whether you're joining us for a mid-morning espresso in New York City, or perhaps a mid-afternoon espresso from, say, Bologna, Italy, or somewhere in between, we really appreciate you taking the time to join our webinar and learn a little bit more about our experiences. So as you can tell from what Yvonne just stated, we have a robust agenda to go through, and this is an hour program, and we also want to be sure we can answer as many questions as possible. So we're going to set the stage and talk some tax rules, but this is not a discussion intended to give you an overview of all the tax rules. We really want to talk experiences. And between Beth, Paul, and myself, we really bring to the table different aspects through our own experiences. So we will touch on some kind of COVID-19 implications, some U.S. information reporting, because that is always key, some traps for the unwary, and really probably save the best for last, which is what if there's a change in the White House? We have an election next week, as most of us and all of us probably know, and we may not know the results of that election next week, but it could really have some huge tax implications. So we want to spend some time on that. So with that, let me set the stage for how we're really going to kind of walk through today. And here's a common scenario. It's not, I don't want to solve this scenario, but this is something that a lot of us experience because we're always trying to balance between income taxes, estate and gift taxes, because a lot of times they have competing results and competing interests. So, let me start off and say one of my few and only acronyms to use will be NRA, non-resident alien. I'm going to assume everybody knows what NYC is, but so let's start off and just say that we have a non-resident alien parent. So those parents that live outside the U.S. They're not U.S. citizens, they're not U.S. residents. In the first year they buy a condo in New York City. Why? Just to use it when they come here for vacation. And the rest of each of those years, it sits empty, so they don't rent it out. Perhaps in year 3, one of their children moves to the Big Apple to come to work, whatever the case may be, and these NRA parents will gift that condo to their child. They might also give them some cash to buy, I wouldn't say a car, because you may not really need one in New York City, but something else. So, this example right here is very common, and it is chock full of income tax issues, estate and gift issues, maybe not all necessarily in the first year, but throughout kind of the lifespan of the ownership of this condo. So, and these are the types of issues that we want to raise awareness throughout this webinar. Yeah, Beth, Paul, please chime in before I move on.
Yeah, to come to mention again something Yvonne mentioned in her introduction, which is a theme that you'll hear throughout today's program, which is the importance of planning ahead of time. Because as you'll see from the slides to follow, if you plan ahead of time before you buy the apartment, before other assets are transferred, it's possible to get excellent income and transfer tax results in the US. The difficulty, which I know Paul, Tim, and I have experienced with a number of clients, is when they go ahead and they purchase an apartment. That's a particular difficult issue. And then they come to us and they say, oh, we have this $10 million apartment or $2 million apartment in the US. We don't have any other connection to the US except our son lives there. How do we avoid US estate tax? And the answer is really, well, if you had come to us before you bought the apartment, we could have given you a great answer, but now it's very, very difficult. So plan ahead.
Yeah, hindsight planning is probably the toughest, near impossible thing to do. So, okay, so that's kind of setting the stage. So let's start with some fundamental US tax building blocks, just to get a few definitional concepts out of the way so that we all know what we're talking about. So who's subject to tax in the US? Well, US citizens. The US is one jurisdiction that basically taxes based on citizenship, and you're taxed on your worldwide income, no matter where you live. So you can be a US citizen, never live in the US except for maybe when you're born and a couple years early on as a toddler, but you're always subject to US tax. Doesn't mean you'll pay US tax, but you're subject to it and you have filing requirements. The second category is residents and domiciliaries. And we'll see later that there's what this means for US income tax purposes is not necessarily the same as what it means for transfer tax, i.e. gift and estate purposes. And so we'll touch on situs of assets. But to give an example, as we move into I'm not going to spend really any time on the US citizenship, but when we look at residency and domiciliary, there's really kind of two categories. There's a permanent residence test, and then there's a substantial presence test. And if I just kind of stop and give an example of, going back to the US citizenship, if I take an example of a UK citizen who's resident in the US, well, that UK citizen will file a US tax return, but probably won't file a UK tax return. Why? Because the UK, I believe, taxes their individuals based on a residency basis, not a citizenship basis. So, but a US citizen who lives in the UK will file a US tax return as well as a UK tax return. Again, they may not pay tax in both because of the mechanics of foreign tax credits and treaties and whatnot, but that is a fundamental difference when we're looking at citizenship. Moving forward to residency, a permanent residence test basically means a green card holder. So if you have a green card and you're here in the US, physical presence in the US is irrelevant. Having a green card is essentially no different than being a US citizen for most purposes. So that is what we refer to as a lawful permanent resident. Where physical presence comes into play is the substantial presence test. And this is where, you have to like mathematics a little bit, because this is where people are counting days. how many days was somebody in the US, not in the US. And a sliver of a day, a stopover, counts as a full day in the US. I'm not going to go through how you get to it, but it's fundamentally a 183-day test, and it's kind of sliced and diced a couple of different ways. Of course, there's exceptions. You can be a resident potentially in the US based on substantial presence, however, not be subject to income tax based on a treaty or closer connections to other jurisdictions. But fundamentally, the substantial presence test is if you're in the US more than 183 days, you are going to be subject to US income taxes. So that's the substantial presence test. So what about COVID-19? A couple of things. This kind of came in. 2020 has been a unique year for all of us. Well, it could be that we have some accidental US citizens, people that maybe were born in the US, whether it's because of COVID and not being able to travel. Some people don't want to travel still if fear of flying. So you might have some accidental US citizenship, or more importantly, you might have accidental US residency because somebody couldn't get out before they were going to cross this day mark. And what happens then? Well, the IRS occasionally does exercise some reasonableness. They don't get too overboard on it, but they did come out earlier this year and talked about, with respect to substantial presence, they basically gave people those that were trapped here, if you will, I use the term trapped loosely, a 60-day reprieve, up to 60 days. And they defined an emergency period and basically said, look, if you were going to satisfy or qualify as a US resident based on substantial presence, and it's within this emergency period, you can take out these 60 days in your total day count. So, arguably, could it have been a greater period? Well, at the time that this came out, I think it's fair to say that most people did not speculate that we would still have this ongoing pandemic. So, but that's some of the things that we've seen with COVID. I want to turn it over to Paul to talk a little bit about domicile now.
So, unlike residency, domicile is used to determine whether one is subject to the U.S. transfer tax rules, gift tax, estate tax, generation skipping transfer tax. And as you've seen from what Tim said, residence is a bright line rule. It's objective, whereas domicile is a subjective concept. Basically, domicile is the intention to remain in the US indefinitely. So it's state of mind. So notwithstanding popular opinion, the IRS and the government have not yet devised a way to read our minds. But what the IRS can do is look at various actions, various tangible phenomena that indicate a state of mind. That is, they manifest an intent to stay in the US indefinitely. And this is called the facts and circumstances test. And on slide 12, you can see some of the different factors that go into the IRS's formulation of a fact and circumstances test. And some of these are pretty obvious: amount of time spent in the US, where the decedent files tax returns. Also things like home ownership. So you've come to the US. Are you renting your residence here, but you actually own your residence abroad, or vice versa? Those would be facts tending to show whether or not you are domiciled here. What about your family? Did they come with you? Are your children in school here, or are they in school abroad? Note that even a green card, while it's certainly a factor in favor of domicile, is not necessarily dispositive. You could be a Brazilian executive of a multinational who's been asked to come to the US to take over US operations for a certain period of time, and you go ahead and you get the green card, but your intention always is to return to Brazil at the end of your term. And one factor that I think is fantastic that Beth pointed out in our discussions last week when we got together to talk about this is the location of your burial plot. You know, because if you buy a burial plot here in the US, you definitely intend to stay here permanently.
It's true. Clients often laugh as though I'm telling them a joke when I mention you should buy a burial plot if you want to establish domicile here, but that is actually something the IRS looks at.
So, I don't know, obviously the importance of determining domicile is, as I said before, it will basically determine whether you are subject to US estate tax, US transfer tax, and the US estate tax, it's fairly hefty. It's a top rate of 40%. Citizens basically have an 11,580,000, and also domiciled residents here have an $11,580,000 lifetime exclusion. That's indexed for inflation. Actually, the IRS came out this week with their inflation figures for next year, so that is due to rise to 11.7 million next year. However, that could be changed depending on the results of the US elections. That number may be different if there's a Democratic sweep, for example, and the tax code is changed. There's what's called an unlimited spousal deduction if you leave assets to your US citizen spouse. Even if I'm a billionaire, if I leave all 1 billion to my spouse, none of that gets taxed at my death. However, if my spouse is not a citizen, there is no special deduction. What there is for gift tax purposes. Every year I can give up to a certain amount, basically tax-free. This year, that amount is $157,000. Once again, that's one of those amounts that's indexed for inflation. Next year, that amount is due to be $159,000. Note that if you're, go ahead.
Sorry, I just wanted to jump in for a moment about that particular issue, because I find in my practice that that's something that is a real trap. People tend to assume that they can give to their spouse. It's their spouse, why ever not? But if the spouse is not a US citizen, there are these limitations. I had a situation once where a client bought a piece of property in his wife's name and was horrified and actually argued when I said to him, well, you spent $5 million on that piece of property, so you've made a $5 million gift less whatever the annual amount is. And he said, but how could that be? That's my wife. So this is something that needs to be watched very carefully, as well as in certain states like New York, where creating a bank account with another individual, including your spouse, creates a 1/2 interest in the spouse in everything that is put into the account. So people don't think about it, and they have a joint account that all of their compensation from their job goes into. If that 1/2 exceeds $157,000, they're making gifts. So that's something to be really careful about.
Right, you know, that's actually, and people sometimes are surprised, but one of the first things we ask our clients when they come is, are you US citizens? Because depending on the answer to that question, the planning could be completely different if one of them or both of them is not a US citizen. And then finally, you know, as I say, if you're not domiciled here and you're not a citizen, instead of that great $11,580,000 exemption, you have only a $60,000 exemption. And even in most countries where we have treaties, and some that figure is adjusted, but in a lot of countries where we have treaties, that $60,000 figure remains. So that's something also to keep in mind.
I think something that Paul mentioned, and I think, Beth, you may have had an example of this, about asking if somebody is a U.S. citizen. While that may sound silly or awkward, sometimes people, if they've lived outside the U.S. their entire life, as far as I know, they may not realize that, they are a U.S. citizen. They know where they were born, yes, but they may not understand the U.S. tax or estate tax implications, what that could mean, because they've never had a reason to. So
I did have an example, which is an interesting example, I think, particularly for this audience. I work with a client who is a green card holder. He's a French citizen, and his children were born in France and are both French citizens. Their mother is a U.S. citizen, but she's lived in France for a number of years, and they came for a meeting with me, and the daughter was talking about how much she wishes to get her U.S. passport. And I said, well, how long did your mother live in the United States? What age was she when she left? And based on the facts, and this is where citizenship gets complicated, but based on the facts of how old she was and when she moved out of the U.S., I said to the daughter, well, congratulations, early Christmas present, you are a U.S. citizen, because they are born of a U.S. parent who lived here for the requisite number of years until the requisite age, so they have automatic citizenship. But I will caution, the law in that area changes periodically, but it just shows how you really need to be aware that things can be a way that you don't expect.
Sometimes the obvious is right in front of you.
Right.
So, there's, a lot of numbers on the slide, and my experience sometimes is when there's more than, say, 5 numbers on a page, the audience kind of goes into what I'll say, Charlie Brown, teacher speaking to the classroom, and you just hear wah, 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 wah. So, but for us, for the planning to be effective, these numbers are important, and why it's important, as Beth and Paul have said, to do it proactively, not retroactively, because that's sometimes impossible. And so we thought maybe, we could touch on an example when we go through this. We thought maybe that we could talk a little bit about examples of kind of U.S. situs assets versus non-U.S.
Right. So this is a really critical point for NRAs, which again are people who are not citizens and who don't live in the United States. So those people are subject to U.S. transfer tax only on what is considered under the Internal Revenue Code to be U.S. situs assets. Now, here on this slide, we have listed what are U.S. situs assets for estate tax purposes. The definition differs in one important way for gift tax purposes, which I have never really understood, but at any rate, there is an important difference, which I'll mention. So for estate tax purposes, the things that NRAs will be taxed on are real property located in the United States, which is why we pointed out in our first example, so important to do planning ahead of time when property is going to be purchased here in the US. Tangible personal property like furnishings, I mean, we don't really care about if you go to Crate and Barrel and buy a couch, that's not going to be important, but antique furniture, artwork, cars, jewelry, except for works of art that are on loan for exhibition. Now, with people of significant means who like to have a residence in the United States, the artwork can present an enormous issue. We work with a client who has, he's an NRA, but he has a house here in the United States, and he absolutely must have $100 million of his favorite art in the house. So needless to say, this has caused us years of practically pulling our hair out trying to figure out how to make that art not U.S. situs property. Unfortunately, we don't have time to go into all of the various ways we've tried to do that. Suffice it to say there are ways, but it's tricky. U.S. situs assets also include cash, by which I mean actual cash dollars, coins. So if someone has a safe deposit box and they have piles of cash in that box. Well, we're not going to ask why that is at the moment, but at any rate, if they die with that cash in the box, that would be considered U.S. situs property. And the last example, which is the one we come up with the most frequently in terms of planning besides the real property, is stock in a U.S. corporation. For estate tax purposes, that is U.S. situs. For gift tax purposes, that is not U.S. situs, which, as I say, is a really interesting mismatch, and I'm not quite sure why. But at any rate, that gives certain planning opportunities. So turning now to what is non-U.S. situs, real property located outside of the U.S., of course, not the U.S. situs property. Neither would tangible personal property located outside of the United States. So for example, if a client wants to transfer a very important piece of art or jewelry to a child, they should not, and the child lives in the United States, they should not bring that piece of art or jewelry into the United States to transfer it. I know this sounds silly and it sounds like real form over substance, but they can transfer the piece of property in, say, Spain, where they live, and have the child bring it to the United States. It's not subject to U.S. gift tax. If they come to the United States with the tiara or the Picasso and transfer it here, it is subject to U.S. gift tax. So some of these things are very, very easy fixes. Shares of stock issued by a foreign corporation, also not U.S. situs. And because foreign corporations are not U.S. situs property, we often use foreign holding companies and put U.S. situs property, like let's say shares of U.S. stock, into the foreign holding companies. So that is an effective means to shield the U.S. situs assets from estate tax. Continuing with non-U.S. situs assets, I'm going to go through these kind of quickly because you can read them and we have more interesting things to get to. But a couple things are important. Life insurance proceeds on the life of the NRA, as opposed to, let's say, someone's an NRA and holds a life insurance policy on their spouse. It's not on their own life, it's on their spouse's life. If it's life insurance issued from a U.S. company, that is going to be U.S. situs property. There's no exception for that, as there is for the insurance on their own life. People often don't realize regular bank accounts here in the United States in a U.S. bank are, and when I say regular, I mean checking accounts, savings accounts, those are not U.S. situs assets, which is kind of counterintuitive. And as I said before, works of art that are on loan for an exhibition are not U.S. situs. So we can move on from here.
I just like to give one story about how important this situs issue is, because obviously, as Beth said, if it's U.S. situs, it's going to be subject to U.S. estate tax, even if you're not domiciled here and you're not a citizen. So when we had a couple, they were German and they owned several hundred million in U.S. stock. Now, under the German treaty with the U.S., that stock is not considered U.S. situs. There is an exception in the treaty, and it says that that stock is German situs. Well, at a certain point, these Germans decided to move to Switzerland. So because they had changed their residence, they were no longer subject to the German treaty, they were subject to the Swiss treaty. And under the Swiss treaty, that U.S. stock is U.S. situs. So we came to them, actually, they came to us, or rather their executors came to us after the survivor of them had died. The wife had died, leaving several hundred million in U.S. stock to her husband. And then the husband died and he retained the several hundred million in U.S. stock, and they had no idea that they owed U.S. estate tax not only on the husband, the survivor's estate, but on the wife's estate. She had died 10 years before. And as I said before, there's no unlimited marital deduction for the U.S. estate tax for a non-citizen spouse. So the executors wound up having to pay several hundred million in tax, interest, and penalty to the IRS. And it's all because they thought they were going to save some money by moving on taxes by moving from Germany to Switzerland, and perhaps that was true for their local taxes, but it was not true at all for the U.S. tax. So this is something that you really need to, make sure you get professional assistance on to make sure that you're planning correctly.
No, yeah, that's a great point. So we're going to go through an example, and I just want to say real quickly, we have probably 4 or 5 examples throughout this presentation. We're not going to hit on all of them, but the examples will be part of the presentation slides that you can receive or have access to. So, but this one we are going to touch on. So let's say, I'll just go through it very quickly. You have an individual who decides to move from Switzerland to Los Angeles, and she moves on December 30th, has every intention of staying here permanently. And on December 31, let's say she moved to San Francisco. This will fit my example better. So, and then on the last day of the year, she decides, one of her resolutions for this year was to swim from San Francisco out to the Alcatraz. So she tries to do that, doesn't make it for one reason or another, some hungry sharks out there. Okay. What happens? However, is she still considered a U.S., is everything subject to U.S. estate tax because she had intention of living here permanently? Contrast that with she moves here, lives here for 4 years, clearly becomes has a green card, is a lawful permanent resident, subject to U.S. income taxes, but never had an intention to stay here permanently. How does that shift the results? So what I want our panelists to weigh in on is, while this is a very simple example, how do you prove intent? What have we seen in that regard? So I'll let Paul and Beth weigh in.
Well, I actually have this situation right now with a client I've been working with for years. Husband and wife, they're quite elderly and had lived, the wife is a US citizen, the husband had actually expatriated. They lived outside of the country for over 50 years and decided they wanted to move back here. They have had substantial assets outside of the country, an apartment in the city they lived in, a country home, a huge art collection. They sold everything. Their children bought them an apartment here. They moved here. The husband applied for a green card. And my strong belief is the minute they set foot in the United States to come to their new apartment, having broken all ties in their prior country, obviously the wife's been a citizen, so that's not important for her, but for the husband, he was domiciled the moment he got off that plane to stay here in the United States. Those are really, really good, clear facts. We don't always get such clean facts.
And that's the issue, because the IRS can't read your mind. So even if this Swiss swimmer had gotten off the plane and looked at San Francisco, looked at the hills and just said, "Wow, I'm deciding right now I'm going to stay here." If there are no external kind of facts that show that she intended permanently to stay here, then there's no case that the IRS could ever make that she was a U.S. domiciliary. They'll have to look at all the facts and circumstances. Here, the death is so quick after she arrives that it's questionable whether a set of facts and circumstances that would support the idea of her living here permanently could be found.
One thing that I think is a really interesting thing to consider is the IRS may want to claim that someone's a domiciliary so that they're taxed on their worldwide assets at their death. However, with the exemption amount so high, the IRS might actually be better off not claiming that they're domiciled here, because then they only have the $60,000 exemption instead of the soon to be, depending on what happens next week, $11.7 million exemption. So you may have a reverse of what we've seen in the past where people are trying to argue they are domiciled here. So it's just a kind of interesting twist on that.
Yeah, those are all great points. So if this Swiss swimmer had sent a text to her Swiss parents right before she took a swim on December 31st saying, "I love it here, I'm never coming home," you know, would that in and of itself be intent? Who knows? So let's move on. You know, Beth talked a little bit earlier about kind of situs and the differences. You know, we started off saying we're always trying to balance or weigh income tax versus gift and estate planning, but sometimes, you know, you're also looking at the estate and gift. So here's just kind of, you know, some a slide on gift tax planning for a non-resident alien. Some of it we've touched on, but do you still want to run through this one, Beth, or?
Sure, let's just go through it very quickly. Because there is no gift tax on the transfer of intangible property, let's take our example of the person who's purchased a cooperative apartment in New York City without asking for our advice. They're in luck because shares of stock in a cooperative apartment are intangibles. So they have the opportunity to gift the shares of stock, assuming the co-op board approves, to their son or daughter. And there's no US gift tax. However, if they had purchased a condo, they are out of luck. In terms of cash, now I raised that before saying that that's cash dollars, but there's have been years of dispute among different practitioners about how to transfer cash. Can we wire money into the US? Well, some people say yes, some people say no. The IRS could take the position that that's actually a transfer of cash dollars. So ideally, if using our example, a parent wants to make a gift to an NRI parent wants to make a gift to their US child, they should have the child open a bank account outside the US and have the transfer made from the parent's non-US account to the child's non-US account, then have the child wire from their own non-US account back to their US account. This used to be the way that we would arrange transfers. Unfortunately, with foreign banks not being as willing to open accounts for US people, and also with FATCA reporting, FBAR reporting, it's not as practical a way to do things as it used to be. So one thing that we've been using a lot is gifts of T-bills, which is as close to cash as you can come, with it being something that's considered an intangible. So that's really important to consider, because if large transfers are being made, you really don't want to take the chance that at some point the IRS is going to argue that, well, you made a transfer that we consider to be cash, so it's subject to the gift tax.
So thank you. We have a couple of questions I want to work in here. So, and since we're on this slide, one of the questions that came in is ownership of an LLC holding US real estate subject to gift or estate tax? If Paul, you or Beth want to address that.
That is a very good and a very tough question. Obviously, if it's a single member LLC, that has no effect at all. But I assume the question is, if it's an LLC that's a multi-member LLC, so it's in effect a partnership, is that going to shield US situs property? We see LLCs holding real estate all the time. So that's really tricky. The IRS has taken the position that with partnerships, which are intangible, in my view, they will look to the underlying assets of the partnership. So the IRS's view would be, well, if you're holding US real estate in that LLC, particularly if it's a commercial enterprise, it's not just a residence, I think they're going to try to assess gift tax. I'm not sure they would be successful. They have not rolled on this for about 50 years, and it's on their non-rolling list. I don't think it's the safest way to plan. I believe if push came to shove, you'd have a pretty good chance of winning, but who wants to be in that argument with the IRS? I'm interested in your views, Paul and Tim.
I'd agree
I
with
share
you.
the same.
Yeah, go ahead, Tim.
Okay. I'm glad we're unanimous on that.
It's like Chip
No,
and
well,
Dale.
I view it as, you know, it's an age-old aggregate versus entity theory with partnerships. And you know, the IRS tends to always rule to whatever favors them best. So it is tricky, and that's why we put the bullet in here because it is a tricky question. But I agree with your view, Beth. Do we have any thoughts? There was another question on how co-owned property might be considered for estate tax purposes.
I'm not sure what is meant, although this may be what's meant, and this is an important point.
Yeah.
If property is owned jointly with a non-citizen, there's a special rule for that, which is it actually can be helpful. Let's say husband and wife own property together. One or both is not a citizen. They own jointly with rights of survivorship. At the death of the first to die, let's just assume neither is a citizen, the entire amount of the property is included in the estate of the first to die for estate tax purposes, subject to the surviving spouse establishing what he or she contributed to the purchase price of the property. Now, depending on the numbers, depending on if they're domiciled here, it could actually be helpful not to claim, or maybe the reality is that the survivor didn't contribute to the property, because then you could get a full step up in basis in the estate of the deceased spouse, and then if the survivor then goes on to sell, there's no income tax except for appreciation above the date of death value. It really depends. You may want to make the argument that there was contribution and then only the amount that was not contributed by the surviving spouse is includable. So,
right, it's basic. Go ahead.
No, keep going.
It's basically the same issue we have with unmarried couples who own real property jointly. As Beth said, there's that rebuttable presumption that the first to die contributed everything and that it's totally taxable in the first to die's estate. And that's for jointly held property. Obviously, if the property is owned as tenants in common, then it's just that percentage interest that the decedent owned that would be subject to estate tax at that point.
So let's move on. Our next, we have about 16 minutes left. So some of these slides, as we work through, we'll see that they're more informational. So we'll turn a little bit to the use of trusts, and we're not going to give an outline or overview of all the types of trusts and whatnot, but let's just kind of go through this quickly, Beth, so we can get to some more examples. So I'll turn it over to you.
One of the really significant and main ways that we plan to avoid inclusion in people's estate of US Citus assets is to create a trust and have the trust buy the assets. If the trust is structured properly, the settlor of the trust will not be considered the owner of the assets, and neither will any of the beneficiaries. So I don't want to spend a lot of time on this. We could spend 3 separate webinars just on this issue, but suffice it to say that it's a very, very important planning tool. There's a slide here with things to consider. The trust can be created so that it's taxable to the grantor, or it's its own tax-paying, I'm going to say entity, even though it's not really an entity. It's a contractual arrangement between the trustee and the settlor. But at any rate, there are a lot of different ways to structure trusts, and this is something that should be very carefully considered in terms of purchasing or acquiring US Citus assets.
So maybe we can jump to this example where we have 2 individuals, D&E, moving to the US, and they were going to they plan to obtain a green card. One, in a lot of these examples, one engages a U.S. tax advisor, one does not. So the one that engages, in this case D, she transfers all her assets irrevocably to a trust. While she's alive, her family members, but not herself, are the beneficiaries of the trust. And upon her death, the trust will be distributed to the persons designated by her in the trust instrument. Contrast that with person E, who didn't do any planning, and we see that all of his assets might be subject to federal estate tax, while hers would not be. So, and while we didn't put numbers to this, it's just a simple example to get people thinking and aware of the power and the importance of this type of planning when coming to the U.S.
I would like to bring up a couple of important, very quick points. One is that trust can be structured to last in perpetuity, so can really be like a family bank. That's a huge advantage. Another is the real gold standard of planning here with NRAs and U.S. citizens or domiciliaries as beneficiaries is to create a trust that the foreign person is considered the owner of. So we call that a foreign grantor trust. And the advantage of that is that if there are no U.S. situs assets which earn U.S. income that must be paid on, like dividends or rent, there can be no U.S. tax, so distributions to the U.S. beneficiaries go out income tax free, and they're shielded from estate tax in both the settlor's estate, because if they're not holding any U.S. situs assets, the settlor won't pay any estate tax, and they can continue on in perpetuity for the beneficiaries. So where the facts allow, this is a kind of planning that is just really the home run.
Beth, when you have those foreign grantor trusts, but when the grantor dies, do you have those migrate then to maybe Delaware to, because we use Delaware a lot because in Delaware you can set up a perpetual trust, which is what Beth was talking about before, a trust that can basically last forever. And when the grantor dies of the foreign grantor trust, that grantor status is basically taken away, and then it becomes a non-grantor trust, which for tax reasons is not as favorable to have as a foreign grantor trust. So what our clients often do is in the trust instrument itself, there's a provision for the trust to migrate, for example, to Delaware and to become basically no longer a foreign trust at that point. If there are no Delaware beneficiaries, however, there won't be any state income tax. There would be federal income tax to pay, but as far as any kind of gift or estate tax, there'd be nothing basically in perpetuity. Tim?
Well, in fact, you could even have a Delaware trust to begin with that's a foreign trust if you, let's say, have a foreign protector or a foreign trustee in there along with the Delaware trustee. So that makes it even a smoother transition.
Yeah, I'll just say real quick before we move on to information reporting, and Paul touched on it. One thing we haven't really made clear throughout this is the state income tax consequences of a lot of this, and that's not something that can be or should be overlooked by any means. There's whether and I don't mean so much the types of the domicile of the trust, but also just the income tax implications coming through from lots of these things. Whether it's New York City, New York State, there's just so much there that needs to be considered, and it can be lead to some unwanted surprises sometimes. Paul, do you want to talk about some of the information reporting?
Wonderful world of U.S. information reporting. I'll be very brief because I see it's already 10:50, and this slide actually has a lot of great information on it. This is very important, and a lot of folks are not aware of it, that the U.S. imposes reporting requirements on its citizens and tax residents. And these are returns that have to be filed. There's no money that has to accompany these returns, but you have to give the information. As I say, I'm going to be very schematic here, but for those who are really interested in this, Bank of America Private Bank, my employer, has a couple of great wealth strategy reports on these different information returns. Happy to send those to whoever would like to have them. But I'll talk mostly about the FBAR, the FinCEN Form 114, also because there's been a couple of interesting cases that have come out recently. And basically, you've got to file this if you own or if you have signature authority over a foreign financial account that at any time during the year the value goes over $10,000. And if you have several foreign accounts, you take the highest value that each of them had during the year and you aggregate them. And if that's over $10,000, you have to go ahead and file this return. So a financial account is basically, it could be a checking account, it could be a savings account, also could be an investment account, it could be a prepaid credit card, could be a debit card, even a gambling account that's based on foreign soil. All of those count as financial accounts. For it to be foreign, it actually has to be located abroad. So what does that mean? If you have an account in the London branch of, say, Bank of America, that is considered a foreign financial account. On the other hand, if you have an account here in New York City, and it happens to be with a UK bank, that is not a foreign account because that's located here. And the penalties for non-compliance can be really, really really huge. If you fail to file the FBAR and the failure is inadvertent, basically there's a civil penalty of $10,000 adjusted for inflation. Right now it's a little over $13,000. But if the failure is considered willful, well, then it's subject to the greater of $100,000 adjusted for inflation, which is like $132,000 and change right now, or 50% of the value of the account, whichever is greater, as I said before. So there's a case that just came out, US v. Toth, Federal District Court in Massachusetts. The facts are really egregious and they're actually kind of fun, but I won't go into them here. But it was totally shady what the taxpayer was trying to do. And basically the total penalties and late fees and interests were over $3,100,000 on an account whose value was only $4,300,000. So the Treasury does not play, okay, with these and IRS, because some of them go to Treasury, some of them go to IRS, as you can see on the chart. They do not play when it comes to these information returns. And so it's really important that you consult your accountant and make sure that your accountant is doing all the proper filings for them. And one more thing, you cannot assert your Fifth Amendment right to self-incrimination. That was just tried in an Eastern District of New York case, and it didn't work, basically. So I want to be very brief. There's a lot one can say on this. I think the two slides give a lot of info, and as I say, I'm very happy to send people. It's about a 7-pager and a 3-pager on these different information returns.
Oh, that's great. Yeah, they do not mess around with that, no doubt. So let's just quickly go through the next 2 slides, which really just kind of discusses some of the traps for the unwary for somebody coming in to the U.S. and we have some of the traps and then really kind of some of the planning tips. And fundamentally what this is, if you go back to one of the first slides, that as soon as you establish, for U.S. income tax purposes, let's say residency, whether it's substantial presence or whatnot, everything is subject to U.S. tax, your worldwide asset. So a lot of the planning really is about how can you basically increase the basis of your assets before you become, cross that threshold? What can you do to minimize your taxes? And that's really kind of what's embedded in some of the examples. So you can read through these bullets, but I want to go through the examples. And one thing I want to add to Paul's information reporting is, because this comes up a lot, is if you happen to be a U.S. resident by virtue of the substantial presence test, yet you can rely on a treaty, let's say if provided there's a clause in a treaty that says, well, your domicile's back in, let's say, Ireland, for whatever example, so therefore you're not subject to U.S. income taxes. There is a little hook in the U.S. regulations that says, yes, but you may not be subject to U.S. income tax, but you still have all these information reporting requirements. So just because you rely on the treaty to get out of paying the U.S. income tax because of substantial presence in a treaty clause, you still have the information filing requirements that Paul was discussing. Okay, so before we move to the example, this is just, again, not an exhaustive list, just some of the typical planning structures that we've touched on and that Beth talked about early on. It's best to plan before you come into the U.S., before you buy these things. And there's not necessarily, no one structure works for everything. But this is where, the expertise comes in, and a lot of you, probably are familiar with this, maybe not familiar at all, but you definitely have to give it some advanced thought. So let's look at a quick example before we turn to our last kind of topic. And this is really an example which is very common. And here you just have two individuals that both buy property before they come to the U.S. They pay $10 million. At the point of time they move to the U.S., the property is worth $200 million. They each have it. They're going to become, U.S. residents. One person basically undertakes some planning. They give Beth or Paul a call and say, here's what's going on, and we want to do this. And so a transaction is structured to basically artificially increase, for U.S. tax purposes, the basis in that property that they acquired up to the fair market value on the date before they become a U.S. resident. And what that does in this simple example here is it basically prevents U.S. taxation from that built-in gain upon the date they become a resident. So let's say when they're a U.S. resident, the value of the property when they sell it is $250 million. They're only going to pay tax on $50 million, not $240 million. And that is a substantial savings, even at a capital gains rate of 20%, which we'll get into shortly. Is that capital gains rate could double depending on what happens with the election. So it's very powerful, very important planning that needs to be done. In very few instances can it be done after the fact. So let's, unless Beth or Paul, you want to add something, I was just going to move on to kind of our last topic.
Oh, I think that was a perfect segue to our last topic, actually.
Yeah. So, what if there are changes in the White House? And this is probably, and I will say, I know we're right bumping up against the hour. We're not going to drop off. I realize we might lose some attendees along the way, but we're going to just get through this and stay on to answer questions if there are any. But what if there's changes? Well, this is what a lot, I know the three of us have been spending a lot of time. We don't have the crystal ball, but what are some things that can be done? So, I'll turn it over to Beth and Paul if you want to just talk about a couple of them. But, this is not an exhaustive list, but something that, we can be looking at.
Well, I'll jump in and mention that I am very busy with new clients, existing clients, all of whom are concerned that if Biden wins and there is a Democratic Congress, the exemption amount, which, as Paul stated, is slated to go up to $11.7 million per person next year, is going to be dramatically reduced. The Biden plan states that it will go down to $3.5 million not adjusted for inflation. So obviously that's an enormous loss of assets that can be transferred without estate or gift tax. So we have a lot of people doing planning now to use up the exemption because there would not be a clawback of the use of the excess exemptions. So I've been saying to clients for many months, use it or lose it. It's now or possibly, I won't say never, but not for the next 4 years at least, if there is a Democratic sweep. So that's primarily what I'm working on now. There are also, as Tim mentioned, potential changes to the income tax system and tax rates, particularly changes in terms of capital gains tax. Paul, why don't you talk about those?
Sure. So one of the proposals of the Biden-Sanders Unity Task Force is that if one's gross income is $1 million or over, then the capital gain rate will increase to the highest ordinary income rate. Now, right now, the highest capital gain rate, except on certain classes of assets like art and collectibles, but the highest capital gain rate is 20%. There's also something called commonly the Medicare surtax, which is 3.8%. So basically, there's the top rate of 23.8% for capital gains. The highest ordinary income tax rate right now is 37%. Under the Biden-Sanders Unity Task Force proposal, that would go back to pre-2017 Tax Act levels, that is to Obama levels. That would be 39.6%. So basically, you're talking then about a rate increase from 23.8% to basically 43.4% top rate, because there'd be that 39.6% top capital gain rate plus the 3.8% Medicare surtax. So that's quite a big jump. Now, as Beth said, you know, this is if there's a Democratic sweep, and that's because it's very difficult to change the tax code unless one party controls the presidency and both houses of Congress. So, for example, when the 2017 Tax Act came in, the Republicans held the presidency and both houses of Congress. It's not a firm, strict rule, but it's basically normally how these things happen. We are actually doing a lot of planning for our clients now, not only with doing the gifting, but also perhaps trying to harvest gain now. We're actually doing what we call break-even analyses for our clients. The problem, of course, is that our clients would have to go ahead and harvest their gains this year, and they have incomplete information because, first of all, we don't know who's going to win. In November, we'll have more information, we hope. Hopefully things will be settled. But we really don't know what's going to happen. You know, if the Democrats have a razor-thin majority in the Senate, they'll probably have a good majority in the House. And if Biden wins, it could be that you'd have like a more moderate senator like Joe Manchin from West Virginia, you know, who would say, no, I'm not, into these tax increases. And so there would have to be some sort of a compromise. And so the 43.4% capital gain rate for folks earning income over $1 million, or the reduction of the estate tax exemption to 3.7 million, 3.5 million rather, that might not happen. And so it's very difficult to plan. But what we're doing, in addition to doing the gifting, and let me add one thing to what Beth is saying, because we get some clients who say, oh, I need to give away $1 million this year. And really, the urgency for the gifting is not for people who are going to give away just $1 million or $2 million. If we assume the worst case scenario that the estate tax exemption would go down to $3.5 million, a married couple really shouldn't be worried about urgently trying to get gift assets out of their estate unless they're comfortable gifting over $7 million. because otherwise it won't really make a difference gift tax wise. Obviously, there are certain reasons to gift, get appreciation out of your estate, which always exist, and that would be true regardless of what happens with the gift tax, the gift and estate tax exemption next year. But we're really talking about clients who feel comfortable gifting over $7 million. With regard to the income tax harvesting, we actually have a program now that we're using, which is called a break-even program. And basically, you plug in a theoretical future capital gain rate, and you plug in the what you expect the growth of the asset to be, and how long you expect to hold the asset. And so there's a, depending on the growth of the asset and also state and local tax, we come out with a series of break-even points. If you're planning on getting rid of the asset before then, it might be better to sell. If you're planning on holding on to it, then it might be better to not sell now and just go ahead and sell later on. Tim?
Yeah, no, so I know we're past the hour, and those were all great points. I think some of the considerations that go into it it's always a balance of tax planning and economic planning. I know some of my clients, while it might be a great idea to even do some loss planning this year, they don't want to sell. They might want to trigger a loss this year to absorb more capital gains this year, such that they're not taxed at potentially a high rate next year. But the positions that they're selling are only depressed now because of COVID, because they're entertainment, hospitality type of positions. So they're saying, well, these will come back. So economically, I guess they're conflicted with whether to, what to do. And that's just an observation and a point that we're always having to, as much as the three of us are passionate about, tax planning, we always kind of have to balance it with the kind of the bigger economic picture. So, there's plenty of other things, and I know we've hit the end. We've kind of taken some Q&A throughout. There's a couple of questions that have come in. We probably won't be able to address them all. Some are fairly long questions, but you do have our contact information here. If we don't address the question, I believe we were able to track who submitted the question, and we can reach out separately. So at this point, I will read a couple of the questions, recognizing that, I guess officially the broadcast is over, but if anybody wants to stay on for a few minutes, I will try to read a couple of the questions, because I know the speakers, we have probably about 5 or 10 more minutes we can spend. So if people choose not to stay on, again, on behalf of Paul and Beth and the chamber, I want to say thank you for taking time out of your day to spend with us. We really appreciate it and hope that this was informative for you. So let me jump back to, and I apologize, the questions come in and they are about that big in terms of being able to read them. So if I squint, that's why. So
Tim, I can throw one question in. One of the issues that came up is, once you have a green card for a certain amount of years, you are considered tax-wise, and for some of these estate issues, you are considered to be a citizen. Can you talk a little bit about that? I mean, you're not considered a citizen, but you're
not considered a citizen, but you are considered a resident. As soon as you receive that green card, probably would have been considered a resident already by virtue of the substantial presence test. But as soon as you receive that green card, you are effectively no different than a U.S. citizen in terms of income tax filing obligations and whatnot. It's different than what immigration would view as U.S. status. I'll let Beth and Paul chime in if they have anything to add.
Yeah, I think, Yvonne, you might be getting at something we discussed in one of our planning sessions, which is if you hold the green card for a period of 8 out of 15 years, and then you decide that you want to give up your green card and leave the United States, you are subject to our expatriation tax under Section 877A, which treats you as having sold all of your worldwide assets on the day you give up your green card, and you have to pay a tax on those. One thing we also discussed in our planning session is the issue of people who get a green card and do not, in fact, spend a lot of time in the United States as they're supposed to do if they have a green card, and can run into the risk of coming back to the United States after a long absence and having someone in immigration say, well, you're not entitled to the green card anymore. And then without warning or without any planning, they are subject to the expatriation tax, which can be very problematic, to say the very least.
And one thing
thank
also
you.
is that by expatriating, you don't get out of the gift tax. You still have to, you're still subject to gift tax. So there's this great mark-to-market tax that Beth was talking about, and then there's also gift tax. So,
well, there's gift tax and estate tax if you're giving to U.S. people and you
if you're
are
giving to U.S. people, exactly. Thanks.
of expatriates called covered expatriates, which is people who have more than $2 million of assets. And then there's another income tax test, but anyway, that's the basic gist of it.
I think another way to finish that off is if somebody wakes up and decides that they want to expatriate, 4 years ago, it was a lot of movie stars. Now it might be athletes, depending on the outcome of the election. You really, depending on your financial wealth situation, you really need to plan for it because you can minimize that cost. You can't minimize how much it costs you to go through the Lincoln Tunnel and pay the toll, but you can minimize how much it costs to potentially expatriate.
Well, you could get Easy Pass.
That's true. That's true. Good point. Let's see. Okay. There was a question, are E2 visa holders residents and domiciled in the US, but are E2 visa holders residents? I personally always have to go back and check my ABCs of visas to know which is which. And so I don't know if Paul or Beth, you know the answer to that one.
I don't. I would think it would still be day count, but I'm not sure.
Yeah, I mean, I know, with student visas, things like that, there are certain visas that basically would exempt you. And I think I had a bullet on one of the slides that the substantial presence test can still be overridden by certain visas, and depending on why you're here and how long you're here for, and what the purpose is. But I make it a
and of course the
point
domicile test would be totally different. Would be facts and circumstances, just like the ones we discussed before.
Right.
Good. I don't know, do we have any additional questions?
No, I think that's,
And you
well,
can
I think
also, the attendees can also reach out to us afterwards, and we can connect you with the panelists in addition to the handout.
okay, there are a couple others, but they're fairly lengthy, and I'm afraid I might misinterpret or misstate what they are. So, okay, perfect. So thank you again, everyone. Yeah, go ahead, Yvonne.
So that concludes then today's webinar. A big thank you to our panelists for sharing your insights on this very complex issue. And thank you to our audience for joining us for today's program.